Welcome to Housing After 60. I am Charles Odell. On this site, we analyze the math and the reality of senior housing to find your best options. Let's get started.
Welcome to another deep dive from Housing After 60. Today, we are looking at 2026 senior mortgage costs based on our latest research at housingafter60.com. If you're planning to secure a new home later in life, you've probably noticed that the rules of the game have fundamentally changed this year. So we're going to strip away all the fluff, look directly at the cold hard math, and show you exactly how to navigate this current market. Okay, so there's this massive and frankly pretty emotional myth out there right now. People think that once you hit 70, banks suddenly view you as this high-risk ghost who might not be around to pay off a 30-year loan. Let's just bust that right now. It is completely false. In the eyes of an underwriter, money is money. They literally do not care if you're 27 or 70. They only care about the mathematical certainty of repayment. So we need to completely reframe how we think about downsizing. You aren't just moving into a smaller home with a nice garden. You're executing a highly strategic capital reallocation strategy. You're pulling dead equity out of a house that's expensive to maintain and securing it into a much more efficient asset. All right, here's our roadmap for this explainer. First up, mortgage approval at age 70. Second, the asset depletion formula. Third, the Section 121 tax shield. Fourth, navigating 2026 loan risks. And finally, your 7-step action plan. Let's jump right in. Section 1, mortgage approval at age 70, the 2026 reality. Right off the bat, you should know about the Equal Credit Opportunity Act. Basically, it makes it completely illegal for a lender to deny you just because of your age. The whole approval process is built entirely on logic and data. But we also have to talk about the friction costs of actually making this move. As we noted on the site, you cannot move for free. Even when you're downsizing to save a few bucks, the transaction itself costs a small fortune. Just look at the 2026 numbers. Loan origination is running anywhere from $1,500 to well over $5,000. Appraisals, they're hitting up to $1,200. Title searches and insurance can easily reach $3,000. And professional movers are charging up to $4,500 just for a standard 50-mile relocation. You absolutely have to factor these closing costs into your equity equation, or you are going to find your cash reserves totally drained before you even unpack your first box. Moving on to Section 2, the asset depletion formula. Replacing traditional income. If you're a retiree looking to secure a loan without a traditional W-2 salary, this right here is your secret weapon. So imagine this. You've got a $2 million portfolio, but you only withdraw, say, $1,000 a month to live on. What happens when you apply for a mortgage? Well, a basic bank algorithm might just flat out reject you for having low income. But asset depletion completely flips the script. It's a technical underwriting model where banks actually treat the overall market value of your retirement assets, things like your 401k or your brokerage accounts, as a virtual monthly salary. This satisfies their incredibly strict income requirements. Let's walk through how this math actually works. It's really just 3 simple steps. Step 1, the bank looks at the current market value of your eligible assets. Step 2, they immediately apply a 30% haircut. Why? Because underwriters are terrified of market crashes. So if you have a cool $1 million, the bank only counts $700,000 of it for the application. Step 3, they take that $700,000 and divide it by 360 months, which, is the term of a standard 30-year loan. That gives you roughly $1,944, which they then add directly onto your monthly Social Security check as qualifying income. Boom. Suddenly, on paper, you have the exact monthly salary you need to get approved. All right, Section 3, the Section 121 tax shield, downsizing tax logic. This is where the strategy really gets good. $250,000 for single filers and a whopping $500,000 if you're married filing jointly. Under IRC Section 121, if you have lived in your current home for 2 of the last 5 years, you can exclude up to these massive amounts in capital gains from the IRS. And with 2026 property values skyrocketing the way they are, so many seniors are sitting on incredible amounts of equity. Think about it. If your profit on the sale is $400,000 and you're married, you literally pay 0 capital gains tax. 0. But it's all about timing here. You really want to time your sale to maximize this exclusion before any potential tax law changes hit us in 2027. This influx of tax-free cash should then be immediately deployed. You can either use it to pay down your new senior mortgage or reinvest it into a diversified portfolio. If you want the full technical breakdown, check the post on housingafter60.com to see how to reinvest this tax-free cash. Next up, Section 4, navigating 2026 loan risks, credit, and appraisals. I really want this number to sink in for a second. $94,000. In 2026, lenders are using extremely aggressive risk-based pricing. The spread between having excellent credit and just fair credit right now can be as high as 1.5%. So if you're taking out a $300,000 mortgage to downsize, that 1.5% penalty means you are going to pay an extra $94,000 in interest over the life of the loan. To the bank, a 650 credit score is just a glaring red flag that your fixed income is stretched too thin. You absolutely must aggressively pay down any revolving credit card debt before applying, or you'll just be handing the bank your hard-earned retirement equity. And it's not just your credit they're putting under a microscope, it's the property itself. Lenders are terrified of deferred maintenance. An HVAC system that's older than 15 years, or a roof with less than 5 years of life left on it, those will immediately trigger huge red flags. If the appraiser notes these items on the home you're buying, the lender will very likely demand an escrow holdback. That means they will hold 1.5 times the cost of the repair in a special account until it's completely fixed. Think about how stressful that is. You really do not want to be managing a roofing crew 3 weeks after moving in at age 70.
So what's the workaround? Negotiation. Your crucial takeaway here is to always force the seller to provide a roof certification and a comprehensive 1-year home warranty before you even think about closing. You have to shift that structural hazard risk right back onto the seller so that your move is clean, simple, and financially predictable. Which brings us to Section 5, your 7-step action plan, the senior approval path.
Let's run through your exact approval path, rapid fire. First, audit your credit report for any zombie accounts. Second, gather 24 months of 1099s and retirement distribution data. Third, check your liquidity. Banks want to see at least 6 months of mortgage payments sitting safely in reserve. Fourth, calculate your debt-to-income ratio and make sure to keep it strictly under 43%. Fifth, write a blunt, honest letter of explanation for any large bank deposits because underwriters absolutely hate mystery money. Sixth, shop around with at least 3 lenders and definitely include credit unions since they're often way more aggressive with those asset depletion loans we talked about. And seventh, the very second you have a contract, lock your rate for at least 45 days to avoid any sudden rate creep. We explore the specifics of every item on this checklist on the Housing After 60 website.
Before we wrap up, I want to leave you with one final, pretty provocative question to chew on. Is your mortgage interest rate actually lower than your investment returns? Never forget that a mortgage is just a tool. It's a liability, plain and simple, and it has to be logically measured against things like inflation and rising healthcare costs. If your investments are making 7% and your mortgage is only costing you 6%, keeping your cash liquid actually makes logical sense. Bottom line, base your choices entirely on the math, not on emotion.
Thanks for watching. For more guides and the full article on this topic, head over to housingafter60.com. Don't forget to check the links in the description below.
Your peace and enjoyment in retirement depends on the right housing strategy. Visit housingafter60.com for our full analysis and cost transparency guides. I will see you in the next video.